Hope everybody's doing well. This evening we have Max Chera from Express Capital in the house. And Max is going to go over construction loans. And without further ado, let's bring on Max. Hello, Max.
Thank you, Vic, so much for having me. It's always a pleasure to be here with the group. And I'm looking forward to talking more about ground up construction, how construction loans work, and even some background numbers to it and what they look like. At any point during this webinar, if anyone has any questions, there's two places you can put them, either in the chat box or the Q&A box. So either or works, just keep me posted. And if you have a question midway, feel free to put it in. If it's relevant to the topic, I will go ahead and elaborate. If anything, I will save it towards the end and make sure to answer everybody's questions. So again, thank you guys so much. My name is Max Chera from Express Capital Financing. We are direct nationwide lenders for rental property mortgages, hard money loans for your fix and flips or your construction loans, and even commercial mortgages. So we're a one-stop shop. Whatever deals you have that you're looking to finance, feel free to reach out to us and we will be happy to talk more about them. But today, like I said, we're going to go into construction loans. So like I said, my name is Max. I'm one of the managing partners. Sometimes my father Martin's on the webinar as well, so we have his information there. He is the CEO of the company. And first things first, I want to make sure that we're on the same page here, guys. Please do not interpret this information to be tax advice, legal advice, or accounting advice, or anything of that nature. This is more just to give you an opinion and education. You still should run all this information by your attorney, CPA, or accountant, or whoever is helping you with your deals. So the goal here, especially when once you've decided to work with a lender, you've kind of picked up this philosophy of using someone else's money to make sure that you're making the highest return and the highest amount of profits that you can on your money, right? Now, obviously, with that being said, when you do use someone else's money, you're automatically making less because you now have an added cost that never existed if you used your own. But the goal here is not for the dollar amount on a single deal to increase, it's the ability to do more, and that more equates to more, right? So right off the bat, if you do more than one deal, you already made more money on your money than you would have if you did a single deal with all of your own. And we're going to go into that and I'll show you guys how that works and how it looks as we go further in. So the first things we want to cover is to understand what a construction loan is. A construction loan is a short-term financing option that real estate investors and builders are usually using in order to keep down their costs to building new houses and can do multiple properties at a single time. Construction loans are only applicable for the time that it takes to complete the project. So you're not staying in a construction loan from before you build it to once it's rented. You're usually just staying into it until you get to that point of where it could be rented or sold for a profit. These loans are distributed directly to the, well, this is actually mixed up. It's actually to the borrower and not the contractor in what's called draws. And the purpose that we actually give it over to the borrowers as opposed to the contractors is to give the borrower more control over the deal and to ensure that whatever negotiations you have worked up with your contractor to ensure that they're going to complete the job and properly is being held to the full, is being accountable, right? So we're going to pass that to you so you could control how they get paid. And draws are usually marked at certain, you could call them checkpoints or completion of the project. So after you have completed, let's say pouring the foundation, you can then go ahead and request your foundation draws. And we're going to go more into that as well. So what is the difference between a construction loan and a home loan? So a construction loan they're different in multiple ways. And usually the biggest thing is the approval requirements. To be approved to construct a home and to be approved to purchase a home, you're going to have a couple of more requirements in the construction side because there's more that has to happen for the deal to actually be valued at the number that we're loaning against, right? So we spoke about this last time in the fix and flips, how we're lending against the future value of the property, the after repair value. Well, here we're lending against the after construction value. So day one, you might have bought the property for $20,000, but you have a construction loan of additionally $200,000, you have more already against the property than the property is worth. So that property must be built in order to ensure that the lender and the borrower are both in good standing. So so because of that reason, you're going to have a little bit more requirements. Both types of financing will require credit checks and other financial information. A construction loan will also require project plans, right? So if I'm going to buy a home, I don't have to tell them what I'm doing and how I'm doing it. But if I am doing a construction loan, you do have to have what's called a scope of work. And the scope of work is there to ensure A, that the contractor is completing the project and at the cost that you were told. B, it's also making sure that the appraiser knows what to value that property at, because now it details what you're going to use and how it's going to be built. And for that, and also C is also to keep in part of the draw process so that we know what was dispersed, what was not dispersed, and what it's going towards to ensure a good project and make sure that everyone's going to be profitable. Additionally, construction loans can be used for the duration of the project. On the other hand, home loans are used to issue for a set period until they are paid off. So what that means is you're generally getting like a 30-year amortization against a home, whereas against a construction loan, you're getting 12 months until the property is completed, and then you're going to either refinance it into a conventional or long-term program, or you're going to usually sell it for a profit. But these construction loans are only for the period that it takes to construct the property. Borrowers that rely on construction loans will usually refinance the property after it's done, even if they plan to sell it. Sometimes they will, just to hold on to it, maybe rent it out for some time and have some cash flow, depending on the market and where you are. You know, if it sells quickly, you may not even have to do so. And both properties will have to go through an inspection/appraisal. Again, the appraisals are going to be a little bit different because as a home, they're valuing it based on today's value, whereas on a construction loan, they're going to value it based on the future value of what the property will look like. Now, what's the difference between a construction loan and a renovation loan? These have a lot more similarities. They're both done in the draw process. They both have a scope of work to ensure what's going to get done to the property and how it's going to get appraised and what work is going to be done. However, there are a few small differences. Construction loans are used for new properties with definitive project plans, meaning that this is a ground up project. This is not a rehab where you're just fixing it up to get it to where it needs to be rentable. Those who use construction loans will also typically transfer into a regular mortgage, which we kind of spoke about. In contrast, renovation loans are for investors who use purchase for fix and flip or renovate existing properties. These loans can be cosmetic and structural. So pretty much they're very, very similar. Now, where they differentiate is more on the terms and the requirements to be approved for them. But as far as the processes, how to apply, how to get your draws, how the lenders are going to look at the deal from start to finish are honestly almost identical. So now let's talk about how they work. These installments are called draws, which get dispersed, and now you can choose how often you want to get your draws. Now, this should be something that's discussed with your contractor / any partners that are in the deal to discuss how you want to go about making the payments, right? Do we want to pay them weekly? Do we want to do bi-weekly? Do we want to just let it be the Wild West and whatever you're completed, you let me know and I'll pay you? Again, the more systematic you are, the better off you'll be, and the more controlled you'll be, and the more you'll be able to grow. But whichever works for you and your business is possible. Before each draw can be made, the lender will do an inspection to verify the estimated cost of the phase. Pretty much, we want to make sure that what was said is going to be completed is completed. So what that inspection looks like is, let's talk about a kitchen, right? So if we're doing a renovation loan and we said that we put in brand new cabinets and we set aside $5,000 for the cabinets, the countertop, and the appliances. And now we go ahead and we say, hey, we need to request this 5,000. The inspector will come by. He'll see new cabinets installed in the property since the last ones. He'll see the appliances that they're plugged in. And he's going to go ahead and tell us and give us a quick report, letting us know that this was done. And then within 24 to 48 hours, you'll have a wire to your account with the funds to go ahead and make your payments. what are the benefits of using a construction loan? So now there are many, one of the few things are that the interest only during the construction, right? So now what that means is, as opposed to a long-term deal or a permanent financing option, you're generally paying a part of the interest and a part of the principal. So what that means is that you're going to have a higher payment if you're paying both the principal and the interest, as opposed to just the interest. So we keep it to a low payment to make it affordable so that you can stay in the deal as, you know, and be in and out as quickly as possible. And just focus on getting the job done and not having to worry about the higher payments, right? Now, they also have flexible terms. Even though you'll need to provide, you know, your lender with the specific plans for your project, the construction loan offer, you know, it's going to come out a lot more flexible than you would if you were to just go into a regular long-term product. And what I mean by that is you have the ability to purchase properties that maybe would not even qualify to begin with. They're not rented, let's say, so they're not producing income. Or even if, you know, and this does happen if you have to change plans midway. And there are ways to do that. Speak with whoever you're dealing with at Express Capital. Just let them know. Let them know it's maybe if it's your first time or so, and you want to make sure that you have aside an extra budget for we'll call it our miscellaneous budget. That's something that can be done, right? So it gives you the opportunity to be more flexible and structure the deal in the way that fits you and the deal the best. And you'll also be able to work around certain project, right? You can get out of the deal as quickly as you need to. So if I need to, if I completed the project in 4 months, even though I have a 12-month terms, I can exit the deal and not have to pay any of the extra interest that I would have incurred if I stayed out the full 12 months. So that's extra flexibility that these construction loans will bring to the table. The next thing is scrutiny provides structure, right? Even though scrutiny might not seem like a good thing, in the end of the day, it's what helps you as the investor stay on time with your timelines, with your budget, making sure that your scope of work is coming through properly, and also giving you that second set of eyes, right? You're now dealing with even investors. You guys look at a ton of deals. As a lender, we look at a ton more because we're looking at your deals plus everyone else's, and we go through, I would say, a couple hundred a week. So it's important so that we can see that what you're doing and provide you with those little insights that maybe we've seen somebody else do, or maybe we've seen a mistake that somebody made that we could help protect you with. What are the disadvantages of using a construction loan? They are a little bit harder to qualify than, let's say, your traditional rehab loan. They are definitely a lot easier to qualify for than your typical conventional mortgage for commercial property. But if you are doing, let's say, ground up, you will need to have some experience, right? So you will have to have at least 3 deals done in the past and show that you are able to complete a ground up project. They have higher interest rates. Granted, there's no question about it. You're going to pay a higher interest rate, but now what that comes with is you're also not paying a prepayment penalty, which most long-term products come with, right? That could be 2 or 3 points right off the bat. Additionally, like I mentioned earlier, you have the ability to leave the loan at any point, right? So if you completed it early, you do not have to stay in for the full 12 months. Let's just say, for example, and we haven't wrote up a deal at 12% in quite a while, actually, but let's just say you got my highest interest rate of 12%. That means that you would be paying 1% a month for each month that you have kept the deal. So if you were only in the deal for 4 months, you paid 4%. And that's why they come with the higher rates, because most people don't stay in that long. Shorter term loans are a risk, right? So especially if you're going for a construction only loan, at the end of the loan, you will need to pay off the entire loan in full, which means that there's a balloon payment to it. So that means you either have to refinance or sell the property, or if you have the cash available in your account, that works as well. But most of the time, that's not the case, right? That's why we're using someone like myself. So if you're going to go this route, make sure that you have a way to pay off the loan. Make sure you have a backup plan for that plan. And you know what? If you have a backup plan for your backup plan, you're even in better condition. So Mariah is asking, is experience requirement consistent across the industry? So when you're going into, for example, a fix and flip, there's a lot of lenders like myself that will work with a first-time investor. If you're buying a rental property, there's a lot of lenders like myself as well that would lend to a first-time investor. However, when you go into ground-up construction, I've yet to find somebody that has uh, that does lend with less than one experience. Most across the board, it is going to be about three, but you're definitely going to need something to get into ground up. Now, a quick tip, by the way, let's just say, for example, because I know there are a lot. I was there as well. Brand new investor. It's my first time. I don't have the experience, but I really want to get into ground up construction. It's my passion. Maybe I even worked for a contractor and I know a lot about it, but I just don't have the experience yet, right? So, what are some things that I could do? The number one thing that you can do is partner up with another investor that has completed these types of projects and maybe does them all the time. Why is that helpful? Number one, you're going to get their rates and their terms, which is probably going to save you a good amount of money, close to what you probably are spending or paying them. Additionally, you're also going to be able to learn from them. You're going to get the job done, which will obviously result in a profit. And at the same time, you're learning from them. You're learning what they do and how they mitigate certain things before they turn into mistakes and before they turn into lots of dollars that could end up impacting your profits. So, by all means, if anyone is interested, they can reach out. I'm always happy to connect the dots. If you have a deal and you're looking for a partner, I'd be happy to share some investors that could probably help you out and get the job done. Make sure you know, okay, so now let's talk a little bit about rates and terms, right? What do they look like, especially on construction loans? So make sure you know what these rates and points and fees look like, by the way. And it's important too, because when you're underwriting your deal, you need to know what these are so that you can make sure that you're profitable. A deal that works at 5% is not always going to work at 10%. So I want to know, what are my costs? What is it going to cost me to originate the file? Are there anything extra that I should account for? And once you have a good outline of this and you've spoken with your team, whether it be your contractor, your title company, your realtor, maybe your wholesaler, you could then you go ahead and use our calculator, which is on our website. Vic, do you guys see my website now as well? Is it taking you there?
Yes, I see.
Beautiful. So if you go here to our website on the deal calculator, and for those of you who would just go to expresscapitalfinancing.com, you can go to business resources and then deal calculator. And you can go in here and put in all the information to your deal, including your interest rate, your points, your mortgage taxes. If your property is going to sell for over a million, maybe you want to add a mansion tax and get the full breakdown so that you know how your deal is going to look on paper and how profitable you will be. And at the end of the whole sheet, it'll give you the ROIs, how much money you'll need to complete the deal, how much you'll have in after payments are made for a couple months, and you could set all that information for yourself. So again, guys, do some due diligence before you get into it. Understand what your cost is going to look like so that you can properly calculate it. What are some other things that we want to consider? So we spoke about the interest rate, right? They are going to be a little bit higher, but like we mentioned, also we can exit this deal earlier so that it doesn't cost us a lot. And we, just so you guys know, by the way, your lender and the borrower, we're both on the same page. We want you in and out of that deal as quickly as possible. We want you to be as profitable as possible, because the more profitable you are, the more deals you're doing, the more you're scaling, the more we're both scaling, right? So this is a person to person business more than it is anything else, and we got to help each other. A large lump sum cost. Most lenders are going to require a little bit more down payment when you're doing a construction loan as opposed to a rehab loan. So, for example, on a fix and flip, you may be able to get away with a 10 or 20% down payment depending on your experience. However, in ground up construction, you're probably looking at more like 35 to 45. Now, another thing also to keep in mind is that when you're doing a construction loan, your purchase prices are going to be a lot lower than when you're doing a rehab property, right? When you're buying land, you're probably buying it for 20, 30, 40, sometimes 50, or depending if you're in Brooklyn, you might spend it for 100. But your after repair value is going to be so much higher. Your construction cost is going to be a lot higher. And that's where the leverage really comes in, where we're going to be able to fund 100% of that construction. Now, another thing to keep in mind, and I would keep reiterating this as much as possible because it is probably one of the most important parts of the deal, is your construction plans and timeline. That scope of work is so important. And the more you follow it and the more you make it your Bible and the more you add timelines to it, the more successful and streamlined your projects will be. And in this industry, time is money. Every day it costs you money. You'll see. When we talk to people, we say, how much does it cost you per day to keep the loan out? How much is your overhead before you make a decision on, should I save $50 on this piece for my contractor? No, you're paying more if you wait 3 weeks for it. Do it today. You already saved money by getting it done today. So keep to your timelines, keep to your scope of work, know when you want to get things done, plan them out, have your contractors on the same page with you. I even have them fill out the scope of work for me because they should be the ones that are writing it. They're the ones that are doing it. And I want them to be able to commit to it. So I don't want to put anything down that I'm asking too much for, right? So, hey, you tell me what's possible. You give me the timelines. And if that works for me, we'll get this started. Borrowing hard money, we're talking more about rates and terms. So the length of the loan, again, they're short term, they're up to 12 months. If the project's big enough, you can inquire for a longer term, probably 24, 36. It's a temporary financing that you're gonna have to get refinanced out of or sell the property to make a profit. And like I said, the lender wants you out just as quickly. This way we can help you get into more deals and make more money. Interest rates vary significantly. These could be based off of location, risk, experience, and a number of factors. Generally speaking, when you go into ground up construction, you're going to be looking at rates between 8.5% and probably 11%, depending on your experience level and the location of the property. Origination points, these are points that are paid upfront to originate the loan for you. They generally range between 1 to 3 points, depending on who you're working with. And then you have fees. There are fees that are getting put into the loan, right? By taking a loan, you're adding on fees such as a mortgage recording tax and other title fees that could come up based off of that. You have appraisals, you have a wire fee, maybe you even have an admin cost. So it's good to understand all of this. And whenever we work together, I'm going to pull it up in a slide or two. You're going to see a worksheet that we're going to share that's going to include all of this information for you. Now, when we do share that with you, that information is more to give you a head start to get started with your due diligence so that you know, hey, I got to ask my title company what the title policy is going to cost me. I need to ask my attorney what his fee is so that I can put them together. But at the end of the day, you should use it just as a starting point. This is not your actual HUD. We can't know all these costs for you because you're doing a lot of conversations outside of us. So here's actually what I wanted to show you where we're going to go into a deal. And let's just say now on this one, I think I put this one as a little bit less leverage. I'm not sure why, honestly, I put 45 instead of 55. But for example, over here, you're buying the property for $100,000. It's going to cost you $250,000 to complete the renovation, right? Our ARV, we're going to sell it for is $495,000. So the total loan amount here is $295,000. So we generally are going to have about close to $70,000 into the deal. 55 of it would be about the down payment, and then you have closing costs as well. So over here, you see you have 12 months. So all this is based off of, if you kept it out for the full 12 months, you would have about 100,000 of your dollars in the deal. And based off of this ARV, you would make 53% on your money, right? Now, again, if I did this without somebody else, I might make 60,000 or 65,000 instead of 55. But now I had to come up with $350,000 as opposed to $70,000 to close the deal. So that's where this all comes in, right? Remember in the beginning, we spoke about OPM, other people's money. The reason that OPM is so addicting, and I'm not talking about the drug right now, guys. I'm talking about the other people's money, okay? The reason it's so addicting is because now your return on investments on your cash are increasing bifold, right? I went from making, if I would have spent $350 to make $65,000, I am less than 30% on my money. Whereas opposed to right now, I can make 53% on my money if I just use somebody else's. And that's the goal here, right? That's what we're trying to help you out with. Now, if you guys also noticed, I remember I spoke about like legal fees and recording taxes and things like that. So like I said, we outline all of that for you to show you, the goal of this sheet is to show you your profits. This is not to sell you the deal or anything like that. This is to show you your profits and help you with the figures so that you know what you're expecting to make on the deal and you can make educated decisions. So what do we look at when we decide if we want to lend to a construction property or not? And we're going to go back to the 6 C's, guys. It doesn't change, right? We're looking at the collateral. What is the where is the property, right? That's going to change the values. How much is it going to be worth? We're looking at the condition of the property. Again, when we're doing ground up construction, there generally is no condition, right? We're buying land. However, sometimes you may have to do an oil test in the property. Let's say if it's in New Jersey or somewhere where you have oil tanks. So there still are certain things that you want to ensure when you are buying land. There still is some due diligence that you can do. It's just a lot less than when you're buying a home. Capacity. Does the borrower, and this is a big one for ground up, does the borrower have the capacity to complete the project and bring it to full completion, right? That's why we always want to see 3 previous deals, because ground up is a different animal than a rehab. You're now starting everything from the bottom up. You have to do the foundation, you have to do the studs, you have to do sheathing, you have to do sheathing and roofing, everything. Whereas opposed to rehabs, maybe you're painting, changing some walls, maybe you're adding a deck. Something, again, these are small construction projects compared to ground up. Capital, do we have the capital to not only take control of the property, to take ownership of the property, but also to actually complete the project, right? Because don't forget, we have to request our money in draws. So do we have enough money to do the first, to get the contractor started with the work so that we could get reimbursed from our draw? Do we have enough capital to make interest payments throughout? These are questions that a lender is going to want to know. Character. Again, I refer to this one as do the right thing, treat your friends as you would want to be treated, and that's really about it. Like, just don't do certain things, like don't be rude. It's that simple. Don't be rude. We're looking at that. We're understanding if you're organized, if you know what you're doing, or if maybe this is your first deal. But again, you can tell us that, and we'll walk you through it. There's no shame in that. Credit worthiness is not one of the biggest on our list, and that's kind of why it's number 6. But it does play a factor. We do want to know who we are dealing with, especially, again, the less experienced we are, the more our credit's going to play a factor. The more experienced we are, the less our credit's going to play a factor. And that's really what we're looking for. And those are going to be what our application is based off of. And now let's talk about the application a little bit. We're going to ask you for maybe a quick application, or we can usually do that over the phone with you and fill it out while we're going through the deal. We'll ask you for an ID, personal identification, the purchase contract showing that the property is now due to close. Property insurance. We'll usually send you our requirements up front, but that's usually something that gets handled once your file is past underwriting and ready to close, because your binder could be built out in as quickly as 24 hours. The renovation budget, the scope of work, right? We're going to need that to get the proper quote from our appraisers as to how much the property will be valued at. And we'll ask for either, we call it a BPO or CMA. They're generally going to be either a drive-by appraisal, since there's no property there yet, or we'll just send in the plans in order to get a proper appraisal for the property. Additionally, 2 other things that I must have not mentioned here. We will ask for a track record so that we know what your real estate experience is like, what you've bought, what you've sold. And we will ask you for a credit authorization so that we can pull credit, and that stays on file with us for a full year. So that means that you can do as many deals as you want with us for a full 12 months. Whether you do 100 deals or 2 deals, it doesn't matter. It stays for a full 12 months. Just to give you guys a little bit of an overview, as I mentioned earlier, I said we have a lot of programs. Just to give you a little bit more insight as to what those programs look like. We have Rental 360, which is a mortgage for your 1 to 4 unit properties. So that's a 30-year fixed mortgage, or you can choose 5/1 ARMs to save some money on the rate, or you can even do interest only. These are 30-year amortized loans. There are no W-2s, no tax returns, very 1099 friendly. So if you're a realtor, doesn't matter, or you don't show your full income, you have a lot of write-offs, it doesn't matter. This is completely based off the asset. So as long as the asset can afford to pay the pity payments at a 1.2 ratio, and you have a credit above a 660, and you either have owned a property in the past, or if you have never had a property, if you're willing to use a property manager, that would qualify you. These LTVs are a little bit old. I apologize, I didn't update it, but it should be 80% for a purchase, 75 for a cash out. We also do no doc commercial mortgages. These are for your properties that are not 1 to 4 residential, right? So these are for your restaurants, for your mechanic places. Maybe you have an industrial property. We do loans from 50K to 15 millions. Our interest rates start at 5.75. We do have full doc options available for the higher loan amounts so that we could get the lower rates as well. We could do 3s and 4s for the million to 2 million plus loan amounts. And we have a lower credit bracket here of a 550 with a max LTV up to 75%. We also do multifamily and mixed use for both rental 360 and for our fix and flips. Just so you know, this is new that we opened up our mixed use back again for the fix and flips. And pretty much same guidelines as our standard 85K. Interest rates are 8% plus. Credit minimum is a 650 with a max LTV of 80%. And then comes our bread and butter, where we originally started, which is our fix and flips. Our loan amount started at 100,000, interest rate at 8% plus, 650 minimum credit scores, and we go up to 90% of the purchase and 100% of the renovations. And those are our programs, guys. And here, if anyone has any questions, first off, I would love to answer them here and now, where we can kind of maybe talk a little bit more about it. Hear a little bit more where you guys are at and what struggles you're coming across. And if you want to reach out to us, personally, you can have our addresses right up top there. You have our email address, which is info@expresscapitalfinancing.com, or you could reach us by phone at 718-285-0806. And we're also on social media. We'd love to see you guys there more. We post a lot about our different webinars where we're going to talk about things like we are tonight. Different programs, and even networking events that are starting to open up now, we're noticing in Jersey and Philadelphia. You can find us on Instagram, Facebook, or LinkedIn. Our name is always going to be Express Capital Financing. Well, that's about everything I have for us tonight, but I would love to hear any questions that you guys have, or hopefully I did a real good job and made it simple enough for everybody.
Anybody have any questions for Max?
So Daniel just posted a question. He's asking, how does it typically work with draws and contractors? That's a tough, in a 203K loan now, and contractor wants to be paid very frequently. 203K loans and investment construction loans are also very different from each other. They're very similar, but they're very different. And by the ways of 203K knows that you're a homeowner looking to modify their home to be kind of what you would need it to live it, to make it livable for yourself. And you're not doing this for investment purposes. So they're generally going to be a lot more inside the process with you, kind of controlling who and what contractors you can use and how that works. So I honestly don't know. I'm not as high level in 203K loans as I am with our investment options. However, generally speaking, in a construction loan, you would negotiate that with your contractor up front, and we can do weekly, monthly, yearly, or daily draws. It's really up to the borrower and the contractor and what they negotiated. Most of the time, I noticed a lot of my investors, they choose a day of the week. Friday happens to be a big one. Hey, every Friday I come around with checks. If you want to get paid, you have to let me know on Wednesday so that I could prepare for a check for you on Friday. So Wednesday, they would have to tell you, hey, I've completed the line item A, B, C, and D. This way you could have the inspector there Thursday, and this way by Friday, the money's in your account and you could write out the check. Now, keep in mind the first draw, most of the time these contractors, they want a deposit to get started. They don't want to just take on the job and hopefully you pay me next week like you said you would. They're going to say, hey, give me 10% down, give me 20% down, some even ask for, or buy me materials. Just give me some materials to start with, and then I'll get started with the work. I don't want to front it for you. So you're generally going to put that money down, have him start the work, and then you, on that first draw, once he starts to complete work, Instead of sending that first monies to him, you may reimburse it back into your own pocket, have him complete a little bit more, and then give him the second draw. Or you could even, sometimes you might not even reimburse yourself on the first one. You say, you know what, I'll keep that first 10% in there for right now, and I'll get it on the end. This way you can keep him happy and keep moving. Or depending on how quickly he's even moving. If he's getting a lot more done than he needs to, and all of a sudden now I, as the lender, release 10,000 as opposed to 5,000, which was requested because it's percentage based. Now you have extra to hold on to that you can use to pay out. So it's all percentage based. If you've completed 50% of a line item that allows $10,000, you're going to get $5,000. If you've completed 90% of that, you'll be entitled to 90,000. So that's really how the construction draws work. And Daniel, if you have any follow-ups to that, please do let me know. So Michael is asking, is the scope of work, does it need to be exact? No, on the contrary, it should not be exact. Your scope of work should always be higher than you anticipate because surprises are almost inevitable. And if you plan to be exact, you will most of the time have to bring something out of your own pocket to make it work. So I would always recommend overdoing the numbers a little bit. This way, you know that you have a buffer. I have a 10% buffer I could work with should something come up that I can still get it done. You know, the last thing anyone wants to be is in a position where something has to get done to the property, but we just don't have the funds to do it. And now we're at a stalemate. So always overestimate rather than underestimate. And you can even add a miscellaneous to it this way that if something does come up, it's there for you. And what that shows is, again, right, we're basing this all off of numbers. So if the numbers for the higher scope works, that means that your deal just has a lot more spread on it where you're more likely to come out profitable. As a professional, I like to say we hope for the best, but plan for the worst. Always.
Always. Anybody else have a question from Max? That's another one, Max.
Do we have any contractors that we work with that we have vetted? Vetted might be a little bit further than I've gone. I do have contractors that I work with that I share their information. Some of them I may have worked with myself. Some of them I may have not, but referred to me from other professionals in the industry. And again, I will always tell you that whenever you're dealing with a contractor or anybody as a professional, you should always get 3 opinions. See where 3 people leave you. The highest number is probably not the way you want to go. The lowest number is probably not the way you want to go. The middle guy is probably just the way it is. We learned that from the Goldilocks and the 3 Bears, right? Not too hot, not too cold. We want it just right.
Makes sense. Anybody else? Looks like everybody's sleeping tonight, Max.
Not gonna lie, it's Monday. Monday's day. I'm a little bit tired. I hear you guys. Hey, hopefully you guys are hustling, looking for properties. The markets are opening up a lot more now. I'm noticing some even courts are even opening. Some of them, they're postponing maybe not as many properties as they used to have, but they're definitely starting to open up. Live events are coming around. So keep your eyes open, guys. Looks like we even have, actually, Michael, yes, I can provide an example of a scope of work. But allow me 1 second to see what questions came in the Q&A box. For some reason, won't let me open it. Wait, are you able to open the question and answer box for some reason, or? Oh, there it is. So Jim is asking, I own a 50 by 100 piece of property that I want to build a 3-family home on. Can I use my ownership of the land as down payment? So the first answer to that is yes. It's not really down payment. The way we would look at it is as skin in the game, right? So when we're lending, we want the borrower to have skin in the game, whether it be generally it's always going to be on the purchase side. There has to be a certain minimum. But if let's just say you wanted to, once you pass that minimum, you can always transfer it over to the construction side. I don't want to confuse you guys too much, but yes, you can use your equity as down payment in the property. The next question is, can I leverage my builder's experience to get approved? That's a great question. That kind of depends on how your experience was documented. So definitely call me. Let's talk about that because there are many ways that we can get a little bit creative to do that, whether you have agreements or something on paper that shows that you've completed projects. Do you do an after build appraisal before I get started so that I know that I'm able to refi into a permanent 30-year loan? Yes, yes, and yes. That is the most important part of this entire process, is ensuring that you have a safe exit strategy. So we will do the appraisal beforehand. This way we know what that looks like. And then we'll do an appraisal when you are ready to refinance. If market conditions have gotten better, you may get lucky and have a better outcome as well. Richard is asking, will you do a 13 lot subdivision? So unfortunately, the answer to that would be no. We don't prefer the subdivisions. We don't want to create a brand new market. There's a lot more information that goes into creating subdivisions. We prefer to do single assets at a time. So it's a lot in between, let's say 2 properties, or just in a vacant lot that you have an opportunity to build on. That is what we're going to be looking to fund. Pablo is asking, can you send me a record? Yes, we will be offering the recording to this event, webinar. We'll send it out in an email. It generally takes about 24 to 48 hours to prepare. But as soon as it is ready, we will definitely send it out to all of our viewers. So really quickly, just to go back to what Michael was asking, if I can share with you guys a sample scope of work. And this is something that I just prepared as well, because we were getting this question a lot. And I felt like it was so important that borrowers understand how to generate a proper scope of work so that you get the right appraisal, right? Because a lot of times I'll hear back from the appraiser, oh, I didn't know that was the plan, that he was going to do a brand new kitchen and make everything with stainless steel and maybe marble countertops. Like, I thought it was going to be standard. That's why it's important to write this information down. The little details are so much more important than the big details when it comes to a scope of work. But give me 1 second. Let me just find it. Here we go. So let's blow this up. So this is a sample scope of work. This is the template that we would offer our investors to pretty much prepare their scope of works on. So they'll put the address of the property, their business name, and then all of these items are actually pre-filled. So you'll have demolition, landscaping, countertops, cabinets, appliances, and all that's already there for you. As far as the description of work, this is where we want to get a little bit detailed and telling the appraiser and your lender, hey, this is what I'm going to do. I'm filling in noticeable cracks in the pool deck area. I'm putting in new kitchen and new baths in the countertop. They're going to be brand new. And again, I would even add over here a little bit more about it. Hey, we're going to put quartz. We're going to put a marble. We're going to put whatever you feel is necessary for your market. We're going to put carpets only in the bedrooms, pre-engineered wood, right? So he's talking about now the quality of the wood that he's putting in there. New tiles in the bath and kitchen backsplash. So they're brand new tiles. Again, do I have to say the color? I don't have to say the color, right? That's not what we're looking for. We're looking for the details of what's new, what's upgraded HVAC unit, new wiring throughout the kitchen and bath areas, right? He's talking more about where they're going, what he's doing, and the details. I've seen some that were a lot more detailed than this. And again, the way the way I explained it is the more detailed you are, the better off you are. The less detailed you are, the worse off we are, right? So if you're not sure if you want to mention something, mention it, right? But yeah, this is a sample scope of work, and I will even send this out in the email with the webinar. I think that's actually a great idea. Jim is asking, can I do a one-time construction to permanent with you? I'm not sure if the question is, can we do business together? If that's the question, the answer is absolutely. I'm always open to doing business with everybody. If the question is do I have a program that does one loan from construction to permanent? The answer is no, it would be in two, but we do incentivize you by reducing fees when you do convert it to the permanent side to do both deals with us. So we will definitely make it worth your time. But yeah, any other questions that we have?
Anybody else? Looks like you answered all their questions, Max.
Good. Well, hey, I'm always happy to be here. Thank you, Vic, for having me. It's always a pleasure.
You're welcome, my friend.
And if anyone else has any questions, they can feel free to email us at info@expresscapitalfinancing.com, or they could call us at 718-285-0806.
Thank you, Max.
Thank you, Vic. Have a
We'll see
wonderful night, everybody.
We'll see everybody on June the 7th, Monday, June the 7th, right here. Next month on Monday. Good night, everybody.
Good night.